Welcome back. I am Liam Malloy, and this is the last chapter in our Intermediate Macroeconomics course, Chapter 20, on fixed exchange rates and optimal monetary systems. So we're going to talk a little bit now about exchange rates that are fixed to each other or to gold, some of the benefits of those, some of the costs of those, and we'll sort of think about why countries might want them and why most countries have moved away from them since the early 1970s. So after World War II, the Allied powers got together and put together a series of fixed exchange rates between the currencies. So between the United States dollar, which was going to be convertible in gold. So it was a way of in some ways going back to the gold standards while still allowing fiat currency. And then, all of the other currencies. So the pound, the franc, the Deutschmark, etc. That fell apart in 1972, and we'll talk a little bit about why. But basically, when, as we saw, the real exchange rate depends not only on the nominal exchange rate, but on the price level in both of those countries. And so if the price levels change by differing amounts, then the real exchange rate is going to be very different from the nominal exchange rate, and we're going to need some sort of devaluation or revaluation. And so this is, this can be a costly process, and in some ways it's better to allow it to float, to allow that process to happen more naturally. We can take a look first at sort of the exchange rates between the dollar and 5 European currencies sort of before and after Bretton Woods. So the dotted line here is from 1971, which is sort of when Bretton Woods fell apart. And you can see that the exchange rates were basically fixed, right? There were a couple revaluations and devaluations. So, one for Germany, one for France, one for Spain. Before 1971, I guess 2 for Spain, actually. But you can see sort of right as it was falling apart, it started to look like it was not going to hold up. And since then, it has floated. And of course, since 2000, the UK is the only one of these with their own currency, right? Everybody else on this list is on the euro. And you can also see that, there was a fair amount of movement sort of in the sort of 1971 to the mid to late 80s. And after that, they were pretty steady. Now, a lot of that had to do with the European monetary system, which we'll talk about as well. So recall that the real exchange rate is the nominal exchange rate and then multiplied by the ratio of the domestic price level and the foreign price level. Remember that P star here is the foreign price level. And so this can be adjusted in 2 ways, right? It can be adjusted through the nominal exchange rate. Now, if we have a fixed exchange rate, that's not changing. And in the short run, we don't expect the price levels to change very much, right? We expect P and P star to be more or less fixed in the short run if we're talking about a year or two. Unless there's some problem with, hyperinflation or something. But in the medium run, the price levels can change, and they can change by differing amounts. And so, if the domestic price level goes up by a lot more than the foreign price level, we'll have a real appreciation, and vice versa, right? If the domestic price level goes up by less than the foreign price level, then we'll have a real depreciation. And so this is the problem with this series of fixed exchange rates, is that when those price levels change by differing amounts, then the real exchange rate and the nominal exchange rate are not going to be in balance. So we can think about, all right, well, let's think about our IS relation in the medium run. And we sort of talk about this equation a little bit more in the appendix. But basically the idea is our first term, so output depends on the real exchange rate, which is equal to the nominal exchange rate times the domestic price level divided by the foreign price level. That's negative, right? Because an appreciation leads to more imports and fewer exports. It is positive on government spending, negative on taxes, negatively on the domestic real interest rate. So a higher real interest rate will decrease investment as well as affecting the exchange rate. Now, we've sort of substituted in here first the nominal interest rate minus expected inflation. And then we said, well, if interest parity holds, then the domestic interest rate is equal to the foreign interest rate. So we have the foreign interest rate minus expected inflation. And then positively on foreign output through exports, right? They'll buy more exports with more money. So if we think about the Phillips curve in the medium run, recall from chapter 9 that our Phillips curve was that the difference between inflation and expected inflation is equal to alpha over L, where alpha is the sort of share going to labor, times y minus yn. So it's all about that output gap, right? And so if we're producing more than the natural level, and so unemployment is below the natural rate of unemployment, then we're going to have higher inflation than expected. And if we have a negative output gap and unemployment is higher than the natural rate of unemployment, then inflation should be below expectations. So the only thing that we do here in equation 20.2 is replace expected inflation with a fixed level. And so basically this says that if the two economies are both at potential GDP, then inflation rates would be the same, relative prices would remain constant, right? So P over P star would be the constant, and we would have a constant real exchange rate. That said, right, that's a sort of a big assumption, right? Because we're assuming that, output is always at that natural level, which we know it's not. And so that's going to be the big problem, is that when, you have one country running hotter or colder compared to the other country, you're going to get differences in inflation, therefore differences in the price level, therefore you're going to have a real exchange rate, which is not in fact constant. So in the short run, a fixed exchange rate is fine, really, right? In the short run, we shouldn't have any problems, but in the medium run, it can adjust even if we have a fixed nominal exchange rate, and it can do that through movements in the relative price level, which is why I always say, what we really care about when we're thinking about the real exchange rate is the ratio of the domestic price level to the foreign price level, because when that changes, that's when the real exchange rate changes. It doesn't really matter if both countries have 0 inflation, or they both have 5% inflation, or they both have 10% inflation, because that ratio will stay the same. But if one country has 10% inflation and the other country has 2% inflation, that's where you're going to see a big problem in the real exchange rate not following the nominal exchange rate. So one example of this problem was after World War I. So the gold standard had been sort of the traditional way of making sure that countries avoided runaway inflation, right? You fixed your currency to the gold, to the value of gold. And then this basically, as long as all countries were on the gold standard, that also led to basically fixed exchange rates, right? Now, during war, this can be a problem because you often have to increase borrowing, increase production more. And so countries often went off the gold standard during war, whether it was the Civil War or World War I. But in 1925, Britain decided to return to the gold standard. And Keynes said, well, that's going to be a problem for us because our prices have gone up by more than other countries' price levels. And so we are going to have a real appreciation at a fixed nominal exchange rate. And that actually led to lower growth in the 1920s in the UK compared to other countries which had more of a boom. Now, interestingly, of course, most countries were back on the gold standard by the start of the Great Depression in the 1930s, and it was countries that left the gold standard that recovered more quickly. So I think it was France that sort of was the longest holdout from going off the gold standard again, and they actually took the longest to recover from the Great Depression.